bring to the table. So let's get started by talking about inquiry. All right, so is this some kind of different inquiry than the one we are acquainted with from auditing? No. In fact, the way I've always explained it is that when we go for an audit, we have a variety of tools that we pack into our toolbox to complete the engagement. When we go for a review, we don't bring all the tools. We just bring two of them, inquiry and analytical procedure. Now, that doesn't mean that we can't use the other tools. We'll just have to run home and get them because we didn't expect to need them, and certainly they're not required. With that context, what are we looking for with an inquiry? Well, number one, it has to be questions to people who can actually provide useful answers. In other words, those members of management and the related teams that have financial statement and or accounting responsibilities. Now, if we were talking about an audit, we would then talk about, okay, if management gives us an answer, we then are going to find other evidence to corroborate it. But that's not what a review is all about. So we are not required to corroborate what management tells us. But that doesn't mean we go, oh, well, whatever they say must be true. If a response they give us, frankly, doesn't sound sensible or logical, then we're well within our rights. And in fact, it is a part of our duty to continue to investigate. So what all should we ask questions about? Well, it's kind of a laundry list, but here we go. First off, accounting principles and practices used and how were they applied? What procedures do they use to record and ultimately classify and summarize transaction? And how do they accumulate other information necessary for footnote disclosure? A straight question, almost a yes/no. Are the financial statements prepared and fairly presented in conformity with whatever the applicable accounting framework is? Have there been any relevant changes to business activities, accounting principles, or accounting practices? Have matters arisen during the course of the review where we say, you know what, this raises more questions we need to ask? And any material subsequent events. Continuing, any significant transactions that occurred or were recognized during the period, especially if they were near the end of that period. If there were any uncorrected misstatements from a previous engagement, what is their disposition now? Have there been any instances of material fraud or even suspected fraud or non-compliance? What significant journal entries and adjusting entries have been made? Has the company received any communications from relevant regulatory agencies? Has there been any unfortunate developments in terms of litigation, claims, or assessments? And have the stockholders or the board of directors or other management groups authorized any specific and relevant actions? Oh, but wait, there's still more. We have to ask about going concern, and if we feel going concern is a legitimate issue, what are management's plans to mitigate that going concern issue? Who are the related parties, and were there any related party transactions, and what were their purpose if so? Were there any significant or unusual or complex transactions, events, or other matters that may have or definitely did have an effect on the financial statements? Are there any significant commitments, contractual obligations, or contingencies that have or might affect the financial statements? And that would include any relevant disclosures. And have there been any material non-monetary transactions for no consideration given in the financial reporting period? All right, so I've used one of my two main tools, inquiry. The other is analytical procedures. That's the A in liar. So analytical procedures are all about developing an expectation. And I really want to emphasize that's first. This is not designed to be I'm going to look at what the client did. I'm going to look at the numbers. And then I'm just going to say, does that seem reasonable? That's not that different than asking someone to count a bunch of items, but telling them to start, well, here's the number. And they look at the items and go, yeah, that looks about right. We don't want that. So we want to come up with an expectation first and then compare what actually happened, recorded amounts or ratios as compared to that expectation. This also can assist us in detecting any unusual relationships, any unusual individual items that could be indicative of material misstatement. Remember, the whole idea here is that analytical procedures may point us in the direction of an issue, and that's good because then that might prompt us to either do additional inquiry, we might design additional analytical procedures, or if we feel it's warranted, we could go home and get some additional tools to investigate. So what kinds of comparisons do we typically see with analytical procedures? Well, current to prior year, probably one of the most obvious, but remember, we can do that with financial statement amounts, but we could also do it with ratios. We could also see comparisons of actual results to budgets or forecasts, financial information, and any relevant related non-financial information. We could also look at how the industry or competitors are performing by way of ratio or other indicators. We could look at relationships between specific items on the financial statements and even look at that to prior periods. And one other interesting one, disaggregating revenue data. Sometimes if you simply look at the grand total for revenue, it hides some of the individual impacts that are going on. So by disaggregating it, in whatever method that makes sense, whether it's breaking it up by geography or product line or division, something that helps us to better understand what's happening, frankly, to make it more predictable. Now, does that mean you have to do analytical procedures at the financial statement level? No, you can do it at any level, anything from the detailed account level all the way up to the summary of the financial statements. But the key question is, we come up with an expectation, we look at the actual results, and hopefully they generally agree. But what if we don't see that? We see results that are inconsistent or significantly differ than our expectations. Now it's time to investigate why. Probably questions of management and potentially performing other procedures. Now there's one thing to bear in mind here. What could be wrong? Well, one possibility is the actual results are in fact wrong. The other is our expectation was wrong. We have to consider both possibilities. Now, the good news is this. If we investigate and find either was the issue, we've reached a resolution. We've got something relevant. Now, if it's our expectation, great, we document and move on. But if it's the client's financials that are at issue, well, we may just have uncovered the need for an adjustment. Now, in terms of evidential matter, even for review, because there's assurance, getting a number of other procedures completed becomes very important. So, we want to read the financial statements for conformity. We've talked about that even with a compilation engagement. We read it to make sure it's generally looking okay. If there were other accountants involved in the engagement, they were reviewing significant components or maybe even auditing a component, we need to get their reports. And we want to ensure that the financial statements themselves do in fact agree with or reconcile to the underlying accounting records. We need to make sure we're on the ball for any arrangement or any information that could indicate there's another related party or related party transaction that management failed to identify or disclose. If there were other accountants or experts that we engaged with to do the work or part of the work on the engagement, is their work deemed adequate? And if there is a going concern issue, ultimately was the going concern basis of accounting the appropriate thing to use? Is there still substantial doubt, especially when considering management's plans to alleviate such doubt? Ultimately, we have to design and perform any further procedures to reach a firm conclusion. If we believe there's something that could or is leading to a financial statement misstatement, we have to continue to investigate to satisfactorily answer that question. Now, what happens if we as the accountant become aware that certain information we've been provided is incorrect, is incomplete, or in some other way is unsatisfactory? Well, we should then bring that to management's attention and request, well, you need to consider what impact that might have on the financial statements. Also, based on management's response and their assessment of the issue, it could also affect what we put into our accountant's review report. All right, we're working our way through that mnemonic. For a short 8 letters, there's a lot to keep in mind. So we have more to go. We haven't gotten to the end of the mnemonic just yet, so I'll see you on the next one.